Today's episode is powered by Lightyear, the investment platform offering stocks and shares ISA with zero order fees. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Stocks are expensive, bonds are finally interesting, and suddenly the boring part of your portfolio doesn't look so boring. With serious forecasters whispering that bonds could beat equities over the next decade, is it time to rethink your portfolio?
We unpick the trade-offs of tilting towards bonds. And in today's dumb question of the week, will zero interest rates ever return? All right, let's get into it. So when we started this podcast, 3.5 years ago, Roman, I realized one thing very quickly. I'm going to have to learn to love talking about bonds. And probably learn to love giving the counter arguments for why you think they should be in a portfolio. But then what happened? You allocated 100% to equities and have been steadfast in that ever since. But now, some other very smart people are making the case for bonds.
That's not to say I don't have any fixed income at all. In my fund portfolio, currently I've got over 50% in cash or cash-like investments. And I'm thinking about putting some money into bonds now.
Don't have too much fun, Roman. Come on.
Well, one man's fun. But I'm glad to see that bonds are finally fashionable again. And I was interested in a story in the FT which was talking about people stampeding into gilts. It's a very popular investment now in the UK. I think that's partly due to education. People are now more aware of gilts and the benefits that they offer, partly due to my channel, I think, but also because people realise that that's a really important part of your portfolio, and yields are now higher.
Yields are now higher, and also stocks are more expensive, right? Those two things go together to make the relative attractiveness of those two assets maybe lean towards bonds. At least that is the case that's being made, perhaps controversially, by some forecasters at Vanguard. Often we think about the 60-40 portfolio as the default, right? 60% in stocks, 40% in bonds. That kind of default assumption goes back many decades. Whereas in recent weeks, strategists at Vanguard made a lot of headlines by saying, well, maybe the optimum allocation for the next decade is 30-70, just 30% in stocks and 70% in bonds.
Yeah, that's shocking coming from Vanguard. I mean, these aren't crackpots. These aren't conspiracy theorists. These are people who are proper strategists who are very well respected, and they base it on this fundamental model. Now, they use this thing called the Vanguard Capital Markets Model, the VCMM, and every time they publish these 10-year forecasts, they use that model. Presumably, what it does is it simulates future returns conditioned on where valuations are today. And a simple fact is that when valuations are high, usually future returns are lower. So you can couch that in various ways. You can express it in various ways. The most simple one is simply to come up with a 10-year forecast for return. Another way to express it is to look at the equity risk premium, which is the amount that stocks are expected to return above the risk-free rate. The risk-free rate being what you'd get with government bonds. Now, when that goes to zero and negative, it means that you'd be better off with bonds. So effectively what these people are saying is that if the expected return is negative, you'll get more money in bonds, so you shouldn't be allocating so much to equity, which is shocking.
And you mentioned their model was based on simulations, and in fact, 10,000 simulations for each different asset class. And they give a range of outcomes they expect over the next 10 years. So for example, US equities, they expect to return between 3.3% and 5.3% over the next 10 years. Global equities, excluding the US, a little bit more, 5.1% to 7.1%. Whereas if you compare that to fixed income, they expect treasuries, that's US government bonds, to return 3.8 to 4.8% over the next 10 years, which is a little bit above their forecast for US equities, just fractionally. But a little bit above for bonds means a long way above in terms of risk-adjusted returns.
And this is another way of looking at how you invest. How many units of return do you get for every unit of risk you take to generate that return? And if you are risk averse, and let's face it, all of us are, then that's an important measure. How much sleep are you going to use to generate that boost in your wealth? And for many of us, I think we're not willing to take too much risk.
And to be slightly more technical, this is to do with volatility, right? Stocks tend to move more per year than bonds, at least developed market government bonds.
Yeah, it depends on the duration of the fund, but let's say you're looking at a global equity index. The volatility of that will be around 16%, something like that. And then for short duration government bonds, you'd get something close to, 1%. For 30-year gilts, you'd get something like an equity-like volatility. So you get everything in between. For a bog standard UK gilt fund, you'd get something like, 5% volatility. So those are the kind of ranges you'd expect with fixed income. It's directly proportional to the duration of the fund.
And so when Vanguard's capital markets model spits out a number roughly equal for stocks and bonds in terms of return, when they do the simulations around asset allocation, that says, whoa, put more in bonds because you're getting the same expected return with a lot less volatility. And that's where this whole 30-70 stocks bonds suggestion comes from. They run something called the time varying asset allocation strategy, which builds on this expected returns model and tries to optimize for higher expected risk-adjusted returns over the next decade. And it's benchmarked against a 60-40 portfolio. And then they look at current market conditions, which are factored into their expectations, and come up with what they think might be a better allocation for today.
And this illustrates just how much the pendulum has swung towards fixed income. So let's first of all talk about the benchmark portfolio, which is what you'd expect over the long term. So this is a 60-40 portfolio. 39% of that would be US equities. The remaining 21% would be international equities, i.e. that's what US people call non-US stocks. And then we've got 40% in fixed income, 28% of which is in US bonds and 12% in non-US bonds.
So that's the default in Vanguard's eyes. But now their model's suggesting something quite different.
Yeah, so this is shifted hugely towards fixed income, 70% fixed income instead of 40%. Now that's primarily in US treasuries, but it's also got US corporate bonds and, of course, US mortgage-backed securities. Then on the equity side, what's really interesting is the tilt that you can see there, where 11% of the 30%, a third of it, over a third, is in the US value factor. 5% is in growth, which remember is the extremely expensive slice of the US market, where the expected return, I think, is negative. And then 4% in US small caps, which again are very cheap at the moment. I've got a fairly big slug of those in my fund portfolio. 2% is in emerging market equity, very volatile, of course, but also on the whole very cheap, except for India. And then 8% in developed markets, ex-US equity, which is also relatively cheap.
So it's the kind of portfolio you might expect right now if you care about valuations. US is expensive, growth is particularly expensive. Let's buy some of the other stuff, right? And let's shrink the equity part of our portfolio down to 30%. And like we said, this did make headlines. But Vanguard also publishes what they expect the median outcome for this portfolio to be and that benchmark 60-40. And it reiterates what we said earlier, that the return isn't expected to be very different. So the benchmark, they expect to return 5.2% per year on average over the next decade, whereas this new optimized asset allocation, they expect to return 5.5%. So barely any different, probably within the margin of error, right? What is very different, though, is the volatility. So the benchmark 60-40, just over 9% volatility is expected, whereas the 30-70 portfolio, they expect under 6% volatility.
Now, that's all very theoretical, but what this really means is less terror. So, for example, the Sharpe ratio is much higher for that bond-tilted portfolio. It's 0.33 rather than 0.18. And if we look at the maximum drawdown, which is the really scary stuff, it's how much your portfolio falls relative to its previous all-time high. The expected maximum drawdown is just over 3% versus 9% for the benchmark.
And you said this is all very theoretical. Like the whole thing is theoretical, right? These are expected returns models this is being based on. And cynics would say Vanguard has been saying something like this, maybe not quite as extreme, but something like this for the last decade, right? They've always been saying US stocks are going to underperform. Maybe you should favor international. Maybe you should favor bonds. And now they've just doubled down on that.
Yeah, but it is based on these simulations. So you could kind of say that it's not really a matter of opinion. It's based on empirical returns from the past. However, if this is a new exceptional period where valuation doesn't matter, and that's always a bit of a red flag for me, but if that's the case, well, maybe they're wrong. Maybe it is some kind of FOMO portfolio that they've constructed, and people will just be kicking themselves thinking, I should have just stuck with equities.
But you say it's subjective in a sense because it's based on historical returns and mapping those into the future, expecting mean reversion, things like that. But then if that were the case, you'd expect all these different forecasters to come up with roughly the same forecasts, which I guess they kind of do. But Vanguard's is particularly bearish right now when you compare it to BlackRock or State Street or most of the investment banks.
Yeah, there are some other notable investment houses which have said a similar thing. AQR, for example, Research Affiliates, GMO. Of course, GMO perhaps is a bit bearish.
That's Jeremy Grantham's place, right?
That's right.
The perma bear.
But look, Research Affiliates is Rob Arnott. AQR is Cliff Asness, really respected people. And we've got PIMCO in the same grouping. Of course, they are a bond house, so they would favour bonds, probably. But look, what makes a market is disagreement. And we've got people like Ed Yardeni, whose graphs we love. Thank you, Ed. He's still very bullish. He still thinks this is going to be looked back on as the roaring 20s. And there are reasons for optimism. AI may be completely transformative, and it may be that GDP simply soars from here in the United States at least. Perhaps it's going to increase productivity globally, and that would push up equity values. It would push up earnings, perhaps. There will be winners and there will be losers, but the US is likely to be one of those winners if it is AI that pushes earnings higher. And of course, we're in a rate-cutting cycle. Again, that's a positive for equities. And who knows, maybe Trump's reforms will be positive for the US economy. So all of these things could provide tailwinds for the equity market, and it could be that we see a new normal in terms of valuation multiples.
Now, after the break, we should question that assumption and think about what could break this thesis that you should tilt towards bonds. But before the break, I thought let's give the last word to Vanguard's senior investment strategist, Todd Schlanger. Now, he did an interview with MarketWatch, which was quite interesting, defending Vanguard's call for this 30-70 portfolio. He said, what we were trying to do with this strategy is really identify the risk tolerance that an investor in a 60-40 portfolio would have in more or less normal market conditions. When you have very comparable rates of return in equity and fixed income over the next decade, according to our forecasts, it just makes sense to overweight the asset class with less volatility and less potential for drawdown. You end up in a situation where our models would imply only taking on 30% equity risk instead of 60% and the remainder in fixed income. Part of the decision and the magnitude by which an investor might want to de-risk their portfolio would be their tolerance for underperformance should the momentum in the market continue.
Now, that's a brave strategist. To do a media interview and talk about really drastically cutting the allocation to stocks is very brave indeed. And there would be huge pushback.
I thought his point about identifying risk tolerance is interesting. Because he's basically saying, if you can usually stomach the volatility of a 60-40 portfolio, well, you can probably no longer stomach that today because of where we are with valuations. You need to dial back your risk to match your own risk tolerance.
I think that's fair. I think that people are just not used to these extended drawdowns and deep drawdowns. What we have seen are some fairly sharp falls. We saw it in April when we had the announcement about the tariffs, but the recovery was super quick. So I'd say the market is still conditioned, almost like a dog, a Pavlovian dog, to respond to these drawdowns by piling into equities and pushing equities back up. At a certain point, I think that enthusiasm for buying the dip may wane. Today's episode is sponsored by Lightyear, the investment app built for a great user experience available on both web and mobile. They've just made their stocks and shares ISA completely commission-free, so you can invest in over 6,000 stocks and ETFs without trading fees eating into your returns. Fund manager fees and a 0.35% FX fee may still apply. You can also transfer your ISA in or out at any time, giving you extra flexibility to manage your money the way you want. You can try Lightyear using the code PensionCraft or follow the link in the description to get up to $115 worth of a US fractional share in your general investment account. Terms and conditions apply. See the description for details. Remember that investing involves risk, and the value of your investments can go down as well as up.
All right, so we've talked through how Vanguard sees the world. In simple terms, they say stocks are expensive, bonds are in line with history, therefore fixed income looks relatively more attractive. And as we said, they believe dialing down risk now might be advantageous from a risk-adjusted return point of view. But what could make them wrong?
Well, kryptonite for bonds is inflation. So if inflation surges, and there are lots of reasons why that might happen, usually it's something to do with energy. If energy prices surge, that pushes up inflation, and then it feeds through into other parts of the economy because of transportation costs and also input costs to companies. And it's usually triggered by an emergency or a war in the Middle East. And let's face it, we're still in a situation where that could quite easily happen. Another reason might be simply that markets overheat. So it may be that the US president starts fiddling with the Fed. Then it may well be that inflation surges again, because low interest rates, while you're stimulating the economy, is a perfect recipe for inflation.
And also jamming up global trade with tariffs doesn't come without its risks. Supply chains are maybe more brittle than people expect.
So all of those reasons, I think, may contribute towards higher inflation, and steadily higher inflation, not just a surge in inflation, but inflation that just runs hot. And if that's the case, then again, that's going to be a problem for bonds. Eventually, it becomes a problem for equity as well, but not until inflation usually reaches about 5% or higher. That's when equity derates.
Should we just explain very briefly why bonds hate inflation so much?
Yeah, so just imagine that you've bought a 20-year UK gilt. Now, you've locked in a rate of return over that 20-year period. If in real terms that's going to be eroded by inflation above 5%, which may be higher than your income, then why on earth would you buy such a thing? Whereas if you buy an investment which adjusts based on the rate of inflation, and shorter duration bond funds would do that, money market funds, for example, or a short-term gilt ladder, and of course equities can adjust because companies can raise their prices. So really it's about inflexibility. Fixed income instruments are fixed, and that's really toxic when you come into a high inflation environment.
And also, I guess, central banks tend to fight inflation by raising rates. And so if you've locked in a fixed rate of interest, well, now you could have got a higher rate, and so people are going to pay you less for your bond, which is fixed at a lower rate.
Yeah, and the certainty which you get with the gilt suddenly becomes your enemy.
So this uncertainty we probably have about inflation right now, I don't think anyone really knows with much confidence what's going to happen. Does that make these 10-year forecasts more unreliable? Because I would have thought that inflation is a really critical input into those models.
Yeah, one thing these models can't do is tell you how uncertain you should be about the model. There isn't a kind of meta model that says this is probably bullshit.
That's our job.
Yeah, that's exactly what I was going to say. It's our job to kind of overlay that cynicism, that doubt about what the model's forecasting. Because if you put garbage in, you'll get garbage out. And if you draw analogies with the past, what if the future's different? So I think we have to overlay that.
And if inflation is one big uncertainty, which could prove Vanguard wrong, maybe there's another elephant in the room hiding, which could punish bonds. And that's just the sheer scale of government borrowing we see across the world right now.
Yeah, I mean, if you look at the United States government, they just don't care. You know, they're carrying on spending far more than they're earning through taxes and plugging the difference with debt every year. And the deficit in the US has been consistently high for many years now. And there doesn't seem to be any sign that they're cutting back on that because people carry on buying their debt. And while that continues, they'll carry on issuing it. But at a certain point, the market's going to bulk. At least that's what many people think.
So to just step back a bit, Why is more bond issuance bad for bonds? Well, I guess it's simple supply and demand dynamics, right? Although maybe not so simple in the government bond market, given the million different dependencies it has. But all else being equal, if you issue more debt, then you should expect to pay a higher interest rate on it.
Yeah, I mean, to a certain extent, there are structural buyers of debt, companies that have to buy debt just to keep the regulators happy. Banks in particular, also insurance companies probably also buy a lot of debt. But at a certain point, that demand is going to be exhausted and you're going to be issuing stuff that nobody wants to buy.
I mean, we are seeing longer duration yields rise in the US and the UK. I think in the UK, 30-year yields are at their highest level since around 1998, last I checked.
Yeah, defined benefit pension schemes, which were the historically big buyers of these long-dated gilts, those pension funds are winding down as the members die. So that huge source of demand is gradually drying up. And you'd expect to see yields creep higher unless someone else stands in to fill the demand.
And to be ultra clear, yields creeping higher means bond prices creeping lower.
Oh, yeah. I mean, if you look at some of these really long-dated bonds, they're trading at something like 30 pence in the pound. I mean, it's like distressed debt at the moment.
I guess that just underscores the importance of duration when it comes to bonds. They don't all behave the same.
No, that's right. I mean, in PensionCraft, we always joke that long-dated gilts are old man's crypto.
I've not seen that joke before.
But if you want to speculate on yield, I mean, none of us are going to live to see this bond mature, the TR73 bond, which is the longest dated gilt currently, that is trading at 30 pence in the pound.
I might see that mature.
Yeah, you might, but I think I'm likely to. You should buy that one for your kids. But just to be absolutely clear, in Vanguard's model, what they'll be assuming is that you've got some kind of 10-year government bond fund. And that would run with a constant duration, which is what you'd get with a fund normally, because as bonds mature, they'd buy new ones to keep the duration roughly constant. Or if you go for an aggregate bond index, like the global aggregate bond index, the average maturity is about 8 years. The duration, which is its sensitivity to interest rates, is around 6 years. So not particularly high. Remember, that's a multiplier. So if interest rates increase by 1%, the price would fall by 6%. And if we look at VGov, which is a whole UK gilt market fund issued by Vanguard, the duration there is around 8.4, because the stock of gilts tend to be fairly long duration. So it's worth keeping an eye on the duration of your fund, because short-term fixed income instruments and money market funds behave completely differently to long-duration government bond funds. Don't inadvertently bet on old man's crypto.
So in terms of the bond part of the forecast, maybe the main risks are inflation and government debt just getting out of control and the bond vigilantes swooping in and driving up yields. That would hurt you. And that would mean tilting towards bonds might not be so clever. But Vanguard could be proved wrong in their forecast for another reason, which is that equities do better than they expect.
Yeah, maybe it is the case that we're going to have valuations stay high for a very long period of time, which isn't unprecedented. And there is no theoretical reason why valuations couldn't go higher still. So it could be that we're in a new structural regime where people are just willing to pay more for equities. There are more retail investors, they're better educated, they're more willing to buy equity. So for all of those reasons, people are willing to essentially pay more. And that's not a situation which is about to change.
I have heard people make that point, which is this idea that we might be in a regime change. Buy the dip is a ubiquitous mentality now. There's broad retail participation in markets, and that's maybe killed mean reversion. And we're in an era of mean expansion. Now, this sounds a lot to me like saying this time is different.
Yeah.
in more words.
Well, look, I'm old and cynical, so of course I'd say that. It just takes a lot of fear to reset our fear sensitivity. And eventually something's going to happen where you just look at markets and think, oh my goodness, this is going to be a bloodbath. And it will be.
Of course, there's another way this could resolve itself, which is that valuations could become more reasonable, not because of a crash in the stock market, but because AI or some other thing comes along and is revolutionary, makes the economy much more productive, grows earnings of companies very fast. And therefore, these high valuations are justified for now and become normal because growth takes off.
Yeah, and it might not just be AI. It could be something completely revolutionary, not in the theoretical world, but in the physical world, like nanotechnology. If we could transform manufacturing by modifying things at the atomic scale, well, suddenly the whole story changes. Or it could be high temperature superconductors. That's something that's gone quiet recently. But if you could pipe energy from here to there with no loss, well, that's going to be completely transformative for the world's energy markets.
Or it could just be really cheap energy, nuclear fusion. I know it's the perennial joke, right, that we're going to get nuclear fusion in 30 years, but that would change everything, right, if energy was driven down to a trivial cost.
Yeah, and I wouldn't give up hope on physicists achieving that.
But all of these things are sort of flocking together with black swans, but in the opposite direction, right?
Yeah, these are the golden swans, and the golden swan that actually materializes is one that we certainly wouldn't have thought about.
But if you look at equity valuations right now, everyone believes the golden swan is coming. And I guess they believe it's AI. They think that is going to transform the economy.
Yeah, I'm not so convinced actually with AI that it is going to be that transformative. We're already starting to see the use cases start to fizzle out. But who knows? It could be that there are applications that we haven't thought of yet, but you'd have thought that by now they would have been pushed out there.
Well, you say by now. I mean, this tech's been around 2 years or something. I think that even if the technology didn't improve from here, if it's the best it's going to get, there's still a lot of rollout to go and we can find better uses for it. Not to say that justifies valuations being where they are, but...
Yeah, maybe. But it's just that these companies are already expecting that. I'd say a lot of that optimism is currently priced in.
Yeah.
So are they going to pull other amazing apps out of the bag? Maybe. But I think the chances of that exceeding the earnings expectations is pretty low.
Of course, the other danger to Vanguard's forecast is that there's always a new hope on the horizon. And it keeps valuations high because, we're excited about AI now. It used to be crypto. Next, it's going to be nanotechnology or whatever you said. And there's always something, which means valuations stay high because we're in an era of quick technological progress, even if it doesn't deliver results.
Yeah, who knows what it's going to be. What we've had actually recently, I think, like you were saying, previously it was crypto, then it was Web 3.0, and Facebook changed its name to Meta, and now it's these large language models. So you're right, I think there has been a succession of new technologies which has pushed up euphoria in the markets. And it's kind of like a game of keepy-uppy. The technological footballer has managed to keep that ball in the air, but at a certain point, something might happen and it's going to fall.
Just needs a change of the wind, doesn't it? Now, to just wrap it up here, Romin, I'm sure you're going to tell me I'm not changing my asset allocation, even though I agree kind of with Vanguard's methodology and I can see the case for bonds over stocks right now. I'm a 100% stocks guy and I'm sticking with it forever. But is that the case for everyone? Or should some people be looking at their asset allocation now saying, it's time to dial down risk?
Well, look, I'm in a weirdly unique situation where I've got a company that I'm very happy with and which generates enough cash for me to live off and is likely to carry on doing that for some time. So I don't really need my investments. So from my point of view, this is not money I'm going to need anytime soon. And that's why I can afford to take 100% equity risk. That's certainly not true of everyone. So this is almost my retirement job. And if you're in a situation where your income has dried up in retirement and you're living off your investment pot, well, you shouldn't be taking very high equity risk unless you have, say, an excess of savings where a drawdown wouldn't hurt your quality of life if your risk capacity is high. But for a normal person who has 60-40 equity risk appetite, yeah, I think there's a fairly strong case to be made that maybe now is a good time for more caution. And the way to do that is to visualize how it would feel if equity markets fell 30-40%. How would it affect you psychologically? How would it affect you economically? Could you carry on living the same lifestyle? Because now is the time to make the change when equity markets are high, not after there's been a crash.
Yeah, absolutely. Owning stocks always requires you to know yourself and know that you can hold on through a big drawdown because it will come at some point. And that's one of the big insights, I think, from Vanguard's model. Whether it's right or wrong, their comparison of their 30/70 to the benchmark, their expectation for that over the next 10 years is basically the same in terms of annualized return. What's different is the volatility. And 100% stock portfolio is going to be way more volatile, probably. So if it's always the case that you must believe you can hold on through a drawdown, that's doubly the case now, because a drawdown is probably a little bit more likely, given that valuations are high.
Yeah, look, I mean, it's really hard when equity markets are just surging upwards all the time. You're looking at your portfolio every day and thinking, oh, that's good. It's really hard to make the case that you should be more cautious. But I think that is the rational thing to do. It's always good to keep abreast of what's going on in markets, and one of the things that we do regularly is publish our weekly market roundup. So if you wanted to learn more about markets with a heavy salting of humour, then why not sign up for that? You just go to our website, pensioncraft.com/newsletter to sign up.
Okay, today's dumb question of the week. Will zero interest rates ever return? Now, we had a long time after the global financial crisis where interest rates were zero or close to zero, and real interest rates for a lot of the world were actually negative. Now, if you own bonds or a bond fund and you're looking for something which would send the price surging again, a return to the ZIRP era would be it.
Yeah, ZIRP, zero interest rate policy, that is something which I think is unlikely to be repeated. At least I hope not, because the kind of environment in which it would be repeated would be one of another crisis. Now, central bankers obsess about this thing called R star, which is the neutral rate, and there are various estimates of it and ways to calculate it. But generally, I think people are expecting that we're going to go back to policy rates of around 3%, maybe 3.5%, and that'll be the kind of neutral policy rate, both in the US and in the UK.
And why do you think we're unlikely to go back to the zero interest rate era? Because a lot of the things that people said caused that era haven't exactly gone away. Some people point to aging demographics, which suppresses demand, and therefore you need stimulation from the central bank and monetary policy. Some people point to technology, which can be deflationary. Those things are still there. So what's changed?
I think firstly, we're not in a crisis. Previously, we were still reeling from the 2008 global financial crisis. That's what it is, which pushed rates down to the lowest level they've ever been. And for the Bank of England, we can go back to the 1600s. Let's face it, that's a long period of time. So this really was unprecedented. And we've been through crisis periods before when policy rates didn't go to zero, after the World Wars, for example. So I don't think it's the case that we can use that as a sticking plaster always. The other reason I think is that central banks don't want to have the zero bound, because if another crisis comes along, there's nothing they can then do. There's no dry powder, if you like, for them to stimulate the economy. So I think having that wiggle room, having that 3% wiggle room where they can dramatically cut interest rates and create this shock and awe, that's really important for central banks.
I have seen people make the case that there are now structural reasons why we should expect higher rates than we had in the 2010s. So firstly, governments are running big fiscal deficits generally. They're borrowing a lot of money, and the stock of government borrowing in much of the world is at 100% of GDP or higher. I guess it's harder for rates to fall to zero when that's the case, because investors demand decent rates to buy your bonds.
And it's important to understand the term premium here, because the short end of the curve is driven by monetary policy, but you can easily go further out on the curve. You can buy 5, 10 old man's crypto durations of 50 years, and that pays you an additional premium. And that's not directly affected by government policy.
And the other thing is there is a huge need for investment, really, which we haven't seen in the recent past. So countries in Europe and the rest of the world are rearming. You've got to spend a lot of money on your military right now. There's also the energy transition going on. Maybe there's reshoring going on as well, where you're trying to build out your manufacturing capabilities. These things take money, and that tends to exert an upward pressure on yields.
Yeah, and in the UK, we've got people stepping back from buying gilts, and that pushes up yields higher. Those DB pension funds that we mentioned earlier, that's definitely one of the factors.
As well as the Bank of England stepping back from buying bonds, or actually selling bonds, right? They're fully into QT and shrinking the size of their balance sheet.
Although they're at pains to point out they don't think that affects yield, so I'm not so sure as they are.
Well, they say it affects yields a little bit, right? We're just arguing about the scale of how much it affects yields at the longer end of the curve.
And of course, we've got erosion of central bank independence. I think that's a really big one. Currently, we don't have that in the UK, but I can see a political outcome where we could see that.
I mean, it's weird, isn't it? Because I can kind of see that potentially going in two directions. So, for example, Trump in the US, if he erodes central bank independence and gets to more or less set interest rates himself, well, he could drive interest rates to zero, right? And then, hey, presto, we're back at zero interest rates. But you'd think that that wouldn't cause yields to fall at the long end of the curve.
No, this is the problem. If you erode central bank independence, the long end of the curve isn't directly affected by the government, and people will sell those US treasuries. So that'll cause a huge steepening of the yield curve.
But then again, he could unleash massive QE to control the long end of the curve, right? Like if you have all the tools of monetary policy under your command, you can engineer a zero interest rate policy across the entire yield curve with yield curve control if you must. But that's going to come with the consequences of inflation, if we believe the economic models that have always existed.
Yeah. I mean, you could have a situation in which there's yield curve control and the US government sets interest rates at zero, then buys up all of its own debt. Yeah, you could do that.
Yeah, you could do it though, right? You could do that. It would be the end of the US dollar system, but consequences, eh?
Yeah, I think all of these are fairly unlikely scenarios.
The one scenario I could see where we could plausibly get back to ZIRP is another crisis. Could be a balance sheet recession like we saw in Japan. Japan's had zero interest rates and is still almost at zero interest rates, despite its debt being more than 200% of GDP. We could have another financial crisis. We could have a kind of deflationary global spiral because of AI or anything, where demand is just not there and central banks need to cut rates again. These are not central cases, but they're not out of the realms of possibility.
Yeah, I'd never say never. You know, after the global financial crisis, after the COVID pandemic, I think we've just got to be ready for these weird, low probability events. And I think the topic of this podcast is very relevant to that. Just make sure that you've got an allocation where you'd be comfortable with those outcomes.
Would you agree with me that a return to zero interest rates is more likely in Europe than it is in America?
Yeah, I mean, I could see that that might be the case. European growth is pretty poor. So there's a very strong case to be made for lower interest rates. And we have seen the European Central Bank cut more aggressively than other central banks. So yeah, I think if inflation doesn't rear its head in Europe, then why not? I'd say that that would be slightly more likely in Europe and the Eurozone.
Just if you're trying to spot where Japanification could happen, well, Europe's got aging demographics, poor growth, low investment. It's got to be a candidate.
Yeah, I think that's possibly true. It really depends, I think, on where some of these innovations are going to come from. Is Europe going to be left out of every single technological innovation and wave of transformative technology? I think that's unlikely, given that they've got so many bright people, so many universities. Something good has got to come out of Europe at some point.
Zero interest rates. That could be good. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.